jump right into it because if you're new to investing, this video is a must-watch. I'm pretty sure that watching it will help prevent you from making some of the most common mistakes in investment. One of the most common investing mistakes beginners make is pursuing performance. Essentially, this involves selecting investments based on their recent impressive gains. For instance, one might come across a stock that has skyrocketed 40% over the past quarter and believe that it's an excellent opportunity to invest for substantial returns. However, just because a stock surged by 40% within 3 months doesn't ensure its future success. As a matter of fact, the only certainty here is that 3 months ago was when investing in said stock would have been most advantageous. The second mistake is establishing impractical expectations regarding their investments. Despite the popular tale of a youth entrepreneur who effortlessly amasses millions in stocks overnight, such an outcome hardly holds true in reality. It's unrealistic to expect a 10% ROI. While the stock market has had an average annual return of 10%, this is over many decades and not indicative of every year. Realistically, your investments will fluctuate in value year to year, so it's important to keep expectations reasonable and avoid getting overwhelmed by short-term changes. My personal favorite among the top 3 investing mistakes is failing to grasp your risk tolerance. Simply put, risk tolerance refers to how much you can handle when it comes to taking risks in investments. Some individuals may not be able to endure high-risk investment ventures that could result in a 50% loss within a year, and that's perfectly fine. By being honest with yourself about what amount of decline you are comfortable seeing in your assets, you will make sound decisions on which investments suit best for you based upon their volatility level or low. Risk options like government securities or reputable blue-chip companies suited if one has low tolerance towards perilous trades, whereas those willing towards hazard better invests at startups likely volatile over time period. When it comes to investments losing value, in the case of active stock trading, one must be prepared to acknowledge when a trade is failing and move on swiftly to the next. The fourth mistake, novice investors tend to retain their devalued investments in the hope of breaking even someday instead of disposing them at a slight loss. They anticipate that it will eventually rebound back to its purchase value. However, usually when an investment declines in worth, there's a reason behind it. It would be wiser to sell off one's shares rather than cling on until losses escalate drastically. The fifth mistake on the list is failing to comprehend your investment time horizon. Investing with a short-term goal of 1 year differs greatly from investing over 30 years. One example being an index fund in the stock market, which may not be suitable for cashing out within a year due to its fluctuating value, but could prove immensely beneficial if you have no plans to touch it for 3 decades and simply let it grow without interference. It's advisable to have a clear time frame in mind when deciding on your investment approach. Regarding index funds, they consist of stocks and bonds that mirror particular markets. As an instance, a tech-focused fund could include top-performing companies such as Google, Apple, or Facebook, among others. These funds possess the advantage of having diversification integrated into them, which lowers risk through owning a range of stocks instead of concentrating investments in one. The sixth mistake, new investors frequently fail to diversify adequately, depending entirely on a handful of companies. This is their sixth blunder. The truth is that even substantial and reputable firms can experience sudden bankruptcy, hence it's wise to have an assortment of stocks in your portfolio. Before I proceed to reveal my top 2 investing blunders, kindly spare a few seconds and show your support by hitting the like button. Your gesture would be highly appreciated. Now, let's discuss the 7th fault investors often make, which involves investing prematurely. This entails ensuring your high-interest debts are cleared and securing an emergency fund of no less than 3 months before considering investment opportunities. Failing to fulfill these prerequisites may place you in a predicament where unforeseen circumstances or loss of income forces you into selling investments at unfavorable periods. It is wise to take care of crucial matters first for optimal outcomes in the long run. Conversely, the biggest blunder that many individuals commit when it comes to investing is failing to initiate any investment at all. If you're too timid or apprehensive about taking risks and allowing your finances to grow through investments, then you'll have considerably more arduous work ahead of you in order to attain a comparable amount as someone who has invested wisely. Bear in mind that retaining funds within a checking account or savings account typically results in interest rates lower than inflation. Therefore, keeping money stagnant instead of growing can lead to its depreciation over time. Why settle for a guaranteed losing situation of not investing when you could invest in your future instead? Don't wait any longer, your future self will appreciate it. That concludes today's message. If this video resonated with you, please hit the like button below. Don't forget to subscribe and watch more at Capital Clarity.